in a broad sense, is kind of characterized by a high density, very active market. And you know, the city also sees this market growing going forward. And according to the Department of City Development, in the coming years, up until 2025, they see 440,000 new workers coming into the workforce. And this is going to require 111 million square feet of new commercial real estate. With that in mind, developers are trying to capitalize on this opportunity, and they're needing to become more creative with their ideas and ways of capitalizing on this. And with that, they are turning to Hudson Yards as a solution to these problems. Hudson Yards is the largest undeveloped property area in Manhattan, and it is located between the two Hell's Kitchen and Chelsea submarkets. It's growing at a rate that is 5 times greater, or 5 times faster than that of Manhattan, and the city is also recognizing this, and they're implementing, they're funding the extension of the Line 7 train, which is not only good for the people trying to work in the area, but also residents in in Hudson Yards and also the surrounding submarkets. So with the submarkets in mind, it's important to realize that these submarkets have similar characteristics and how these will have an impact on the Hudson Yards and as they blend together. These submarkets kind of are characterized with a different kind of, a very cultured type of person that is very interested in, you know, theaters, galleries, and restaurants, and you know, this is very important for the implementation of the Hudson Yards, because these are going to be a huge impact on what is put into the retails and outlets in the area, but also how the people react to what's put into these commercial environments. But now that I've given you a little background on the market, Natalie is now going to talk about the property types in the area.
Thanks, John Mike. So I'm going to just highlight a few main trends in each property sector, starting with hotels. It's important to know for hotels, the tourism fundamentals in general are performing really well right now. They're all on the uprise. New York in 2012, broke its own record for most visitors, 52.2 million visitors to New York City, and they spend about $32 billion annually. We also have, on the upswing, all the hotel fundamentals across the board. We have RevPAR, ADR, and occupancies all steadily increasing. So those provide a lot of opportunity for new development. However, in our highest and best use analysis, we concluded that for this site in particular, hotel would not be highest and best use. Moving on, we have multifamily. Multifamily in Manhattan is characterized by extremely tight vacancies of about 2.22%, and high rents, which allow for a lot of opportunity with new supply and construction, and that, coupled with the roughly 48,000 people expected to come into Hudson Yards in the next year or so, provides a lot of opportunity. And if you look at the bottom of this slide, you'll see the 6 properties that we identified as being most comparable and most similar. They helped us get our rent per square foot and see what kind of amenities we'd offer, things like that. So it was a very similar product offering, and those were the ones that we looked to. Next, we have retail. Retail clearly has a lot of potential. As you'll see, there's the average square footage in Manhattan is 96 square feet per person, and so there's a lot of room to move up in this area when there's only about 60 square foot per person. However, it's important to note for this sector, it's all about the timing. So retail, unlike office and residential, isn't really going to take off right away. We anticipate that retail will be coming after and more supportive of these once they pick up. And finally, we have the Hudson Yards office environment. As you can see on the map, we've identified the location of some of the new construction currently underway. This will bring about 13.5 million square feet in the next few years. And then also it's important to notice that net absorption, usually you think of downtown and midtown as the most high-performing office areas, but actually it's the west side right now that saw the largest absorption in 2012. So now that you have a better idea of the the property sectors and the general market area, we're going to talk a little bit more about our development. As Justin mentioned earlier, we're incorporating multifamily, retail, and community center in there. We elected to use all of the allowable floor to area ratio, so that's a floor to area ratio of 15. We selected community space, that includes the affordable housing, the 2080 program, which gave us 5.5, and the community space, which allowed us to build up 3 additional floor to area ratio units. So our building is going to be 22 stories. The multifamily component makes up the largest with the 2080 program. 79 of the 397 units are affordable, and the rest are market rate. We have retail on the first floor to take advantage of the frontage, and then community center, about 4.5 stories of that, 2 of which will be office space. We've decided that most promising tenants for that area would be like minute clinic type things that are not as high tech or high equipment, and they're driven by the high foot traffic in the area. We've also identified that satellite university campuses would be another potential tenant. I also want to talk about our development timeline real quick. We plan to begin right now with planning and negotiations. That'll take about a year. So about this time next year, we'll break ground with about a 20-month construction period, and we will hopefully be leased up within the first 2 years of operations. We also want to really highlight the multifamily component of our deal, since that's most of our square footage. You'll see there we have a unit mix that incorporates a variety of different sizes of units. We think that since we're having such a diverse, all the office space is bringing such a diverse group in, that we wanted to be able to offer a lot of things that appeal to very different residents. And so that really allows for that. And it's mainly studios and 1-bedrooms. We also elected to do the 2080 affordable housing program. Justin will talk more about this later, but our reasoning for doing so has to do with obviously the increase in floor to area ratio and the tax abatements, but we also considered the fact that Manhattan, unlike Queens and Bronx, has rents high enough to support this, even though you're taking a little bit of loss on those units. It's making up for it in the really astounding rents that they're receiving right now. And finally, the property values, which are expected to increase as more development takes place in the area, it'll really help offset that. So now that you have a better understanding of our development, I'm going to hand it off to Val, who's going to talk to you about how we're going to make it work financially.
Thanks, Natalie. So first and foremost, we really need to identify how much can we feasibly pay for this land to make this deal work. So in looking at market comparable land sales, in the latter part of last year, we can see that we have an average by weight market value in terms of sales price per square foot for land in the Hudson Yards area of just above $1,800. Multiplying that out by our square footage of land of 22,400, we're getting a proposed market land value of just below $41 million. That said, we do believe that's in line with market rate. Given that all of these land comparables closed in the last year, we believe that the market is actually already pricing that new development that we're seeing from, the Brookfield-related companies and such, already priced into that market. That said, we're suggesting that UDP open their bid at $42 million. That's a 2.7% premium on market rate. However, we do recognize that UDP can afford to pay about $48 million for the land if that initial bid weren't to succeed, and that's a 17% or so upgrade over market rate. That said, we'll move on to sources and uses. We'd like to initiate an LP partnership for 95% of the equity, with UDP putting in 5% of its own. The debt financing number you see up here is the construction financing of about $106 million. This is actually going to be at a 62% loan to cost, which is outlined as market rate for us. Next, we have land here pro forma at $42 million, that initial bid price that we talked about before, but we'll tell you later a sensitivity analysis if that land were to increase, how that would affect our returns. Next, we have hard costs and soft costs for each of the property types, which will fit out to a total construction cost of $173 million. Here we have a list of our assumptions. We do believe that all of our assumptions are in line with the market, as Natalie mentioned earlier. I'd like to call your attention to cap rate here, the second to last line. These are all of the cap rates as per RCA for each of the property types. However, we did apply a 25 basis point spread to the top of each of the cap rates given by RCA as the market average, simply because this area isn't seeing as much infill. So we don't see currently the cap rates being as low as that market, but we do present another sensitivity analysis later that will show how our returns will foot out, with a different cap rate spread. Moving on to cash flows, we can see the initial equity from UDP and and our LP at the top. In 2014, we looked to 40% of equity being contributed, with 60% coming on the line in 2015. You can see our NOI below, starting strong in 2016 and growing through 2020. The reason that we believe we can project a positive NOI in 2016 is because of the pre-leasing that we'd like to initiate during the construction period. Moving on to leasing and capital costs, you'll notice that we have no tenant improvements modeled out for our initial TIs. We did this believing that TIs for especially retail and office are actually already modeled in when considering construction costs. So for that reason, they're not modeled out here. But in further cash flows in the model, you'll see that we have renewal TIs and rollover TIs. Next, we have leasing commissions, which typically aren't pro forma into construction costs, so we've taken them out of cash flows here. Next, I'd like to call your attention to debt service. What we do suggest is that in year 2, when we see that positive NOI, we actually approach a bank and go to them for a 70% loan to value, given our pro forma NOI for 2017. That way, we'll essentially buy down our construction financing and be able to cash out about $33 million from the deal. In order to make returns work, given that the LP is requiring an 8% annual preferred return, we essentially suggest that that $33 million be held in escrow and then paid down to pay down the LP's annual preferred return. That will ensure that the LP has that 8% annual preferred return. That being said, all cash flow will then be split with that 25-75 promote that we're seeing. Here you can see the equity split. In the LP analysis above, you'll notice that we do carry the interest in 2014 and 2015 simply because that's what we see as being necessary in the market right now to get a deal done. The profit share analysis below will show that both the LP and UDP are going to be cash flowing in each year. We do have residual value upon exit. We're projecting an exit in year 5 for reasons that Justin will cover in just a moment, with an exit cap of 5.19. That exit cap is actually derived from a weighted average of the different property types weighted by their NOI contributions, because we think that gives us a more accurate value than weighting them by their square footages. We then derive a residual sale price, taking out that loan balance, factoring in 6% sales costs. We can see that we're returning our preferred return to our LP and then splitting that cash flow 75-25 again. So with that, I'll hand it over to Justin Yap to talk a little bit more about our returns.
Thank you, Valerie. Man, she threw those pretty quick. So let me just back up and highlight what it means for the investors, the LP and the general partner. For the limited partner, it represents a return of 18%, slightly above what they kind of required from market, from 12 to 15% in terms of an IRR. And what it means for the general partner, urban development partners, it means a 29% IRR, given our base case model. As you can see, the schedule of cash flows in 2014 and 15, both equity sources have to contribute money to obviously construct the building. And then in 2019, year 5 of the model, they get the residual value based on sale. So how are we going to accomplish this? The financing sounds pretty reasonable and provides a great return for both partners. But we plan on getting it done by selling the property in year 5, as Valerie mentioned. After the lease-up stabilizes in 2018, we think that UDP should market the building for sale. And the open market, who'd be interested in this property, we believe it's institutional investors. Institutional investors like TIAA-CREF, MetLife, CalSTRS, and Prudential Real Estate. The reason we suggested this is that in Manhattan alone in the fourth quarter of 2012, 41% of the transactions, the purchases, were done by institutional investors. These 4 alone purchased just under $3 billion worth of multifamily property across 22 different investments. To kind of support that assertion as well, I'd like to call your attention to this chart. It's 5 comps that we've put together in the for our market within 1 mile of the Hudson Yards site. What it does is it illustrates, an average of about $600,000 price per unit, a measure used to value multifamily. These buildings were constructed from 1998 to about 2005. Where we stand relative to this market is a sales price per unit of $583,000, which therefore we believe is within line, within the market as it stands today. And what that means going forward is that this building was constructed in potentially 2015, so it'll be much newer than these properties. So we think it's a very feasible approach, and that our exit strategy falls in line with market feasibility. However, with all that said, there are some risks I like to draw to UDP, especially the developer. First is the abundance of commercial real estate going up in New York City and specifically Hudson Yards. The millions of square feet of office, retail, and multifamily, especially starting in 2017 with related companies' $15 billion investment, it's just something that you have to take into account and understand. They have a certain place in the market, building a very grand property. So, we do believe that our multifamily especially has a place in the market, as John Mike said, connecting more to the Chelsea and Hell's Kitchen submarkets, more of a 22 stories, not too high rise, and more of fitting the profile of the market. The second risk we have to call your attention to is the mixed income concept. We identified it as sort of a risk is because we believe that there could be negative perception from the market rate users and those leasing at market rate, given that there's affordable housing within that same building. And whether or not that perception is true, it's just something we'd like to point out. The third risk of this investment is it's obviously residual dependent. For a developer, we understand a lot of that residual is made on sale, but we'd like to point out, especially in this investment, the IRR is generated mostly through the sale of the property in year 5. For the GP, for the LP, I'll show you in a sec, the LP stands pretty well. But the final risk to consider in this development is interest rate, something that has been a hot topic in the last 4 or 5 years. What I mean by that is that interest rates are trading at an all-time low, 1.7% on a 10-year treasury today. And that's something that's incredible. 10 years ago, 15 years ago, 20 years ago, your interest rates between 8 to 12%, and that's what you were working with. These low interest rates affect permanent financing and cap rates as well, how buildings trade. So going forward, we'd like to note that interest rates could rise based on the 10-year, 30-year treasury, and both push up permanent financing rates as well as cap rates for your investment. So I'd like to draw your attention to our sensitivity analysis, first for the LP and GP with our land basis as well as the exit cap rate. As you can see, the blue represents above a certain expected return. For the LP perspective, it's 12%. Across a range of $36 to $48 million on the investment in land and a cap rate based on a spread of 75 basis points, the LP sits pretty well. And this is really a function of their 8% preferred return annually as well as their 75-25 profit sharing split. However, for the GP, the story is slightly different. You start noticing that past $42 million, the deal starts getting a little, I don't want to say dicey, but the deal gets a little less attractive. And you can see his cap rate. If cap rate were to increase about 45 basis points to 5.64%, the deal starts absolutely not making sense for the developer undertaking the risk to build this property. So that's where we recommend the $42 million basis for land in our base case, here in the center, as a pretty good place to start your bid. Next slide. Now, the second slide talks about sensitivity analysis based on LTV as well as interest rate on your permanent financing. The returns assume the $42 million land value and the 5.19% cap rate. Again, the LP sits in a pretty positive position. They're solidly returned, so when you're approaching your LP for investment, I believe it won't be too hard for you to find one in that sense. However, again, for the GP, you should watch out on the LTV and the permanent financing you use in the sense that, levering up, if interest rates were to stay the same, do provide a higher return for, you, the general partner. However, the interest rate risk could kick in, and that permanent financing you obtain, whether it be LIBOR plus basis points or something like that going forward, could really affect your returns and push the deal to something that's not very attractive. So with that in mind, analyzing first of all the submarkets, our development plan, our financial analysis and risks, I'd like to open the floor for questions and hopefully answer them. Absolutely. So in this model, we like to call it the attention that the LP requests an 8% annual preferred return. So that 30%, the $30 million we held in escrow, so the $30 million basis comes from your shift from construction financing into permanent financing. You increase the loan to cost from 62% to loan to value of 70, and the cap rate, the second year NOI used to get that loan to value, the permanent financing on loan to value is 70% of your building value based on second year NOI over 5.19% the cap rate we used. So that's kind of, so then that value is about $139 million, and then when you pay down your construction balance, which is about $106 million, you have about $33 million, kind of free cash. The reason why we decided to hold it in escrow, which I'll kind of go into a little bit here, is we wanted to guarantee the LP the 8% annual return. That was something that was stated, kind of in the case proposal and something we wanted to mimic in the model. We do recognize that holding $33 million in escrow, though, against your limited partner is something that may not be as attractive to them. So another thing we did put together, we don't have it on a model today, but I can walk you through it, is paying them that, the $33 million or that balance out in the first year once we receive the cash out. So what that would mean is taking $33 million, financing a little bit of operation loss in the first year due to rent abatement and leasing commissions, and then splitting that remaining $30 million, 95-5, how the equity balance is split. So in that case, the LP would receive about $28.5 million, and the GP about $1.5 million. What it does then is it reduces their basis on the investment. It gives them a 41% return, and it gives the general partner some equity as well. But then what that also means going forward is that in years 2 and 3, what would be consistent 8% return with our spread payments turns into a 1% return in year 3 and a 6.5% return in year 4, just for the preferred cash flows to the LP. So it's something it's a detail we like to just point out, but we've considered it.
From a practical standpoint, if LPs would rather get the cash back,
Okay.
have the choice to reinvest.
Okay.
From an ownership standpoint, you would consider holding some money back and the borrower to cover unforeseen costs in ways to some contingencies, but that probably would have played out in construction for
Okay. Thank you.
speed and small as a new worker. And it's very common and proven it works. It's not no risk at all.
Okay. Yes. Natalie, would you like to discuss that?
Yeah, so our Florida area ratio of 15 is derived from the base Florida area ratio of 6.5 given in the zoning, and it incrementally steps up from there. There's a 5.5 increase that we're able to obtain from doing the 80-20 affordable housing program, and then another 3 units that we're able to obtain from doing the community facility. In the financials?
So within the financials, we actually, where it says office NOI is where it says community center NOI. The community center is labeled by I believe in the zoning laws from New York, a community center can consist of like a nonprofit university, a medical office center, things like that. And so the way we built it out in our model using Argus and Excel was build it as if it was an office tenant, which is a little lower TIs than your typical Class A office building, for example, on 6th Avenue with a lot of banks. So we modeled it as office, but that's where the community center kind of fits in. Yes? Absolutely. Natalie? The question was regarding the parking garages, the costs of it, and the assumptions going forward? Okay. Okay, and how you plan to monetize the space?
Sure. So the parking garage costs were built into the given construction costs listed in the case. So we were assuming that the construction costs we used included the parking garage. As for making revenue off the parking garage, we looked at what the comparable properties that offered them did and what they charged, which turned out to be about $300 a month for parking. So that's a nice extra bit of income there to help offset some of your costs associated with it, and we use that as our revenue, that projection. So it turned out to be about a good amount of extra income a year.
Yes. Yes. And so I'll take at least the first part of that question. In terms of the debt assumptions, the construction financing, in terms of the oh, sorry, absolutely. So the question was regarding the mortgage assumptions in regards to the construction as well as the permanent financing and how we, first of all, derived them since they weren't on a slide. Is that correct? Okay. So for the construction financing, the first part, the loan to cost of about 62%, I think it was 61.5%, was provided to us in terms of a market assumption. And the interest rate actually on the construction loan was irrelevant because we were instructed and I guess told to assume our market or our interest financing and payments were built into the soft costs of construction that were provided for each asset class. In terms of the permanent financing, I'll let Valerie talk further about how we converted to permanent financing those interest rates.
Sure, absolutely. For permanent financing, what we did was we looked at the different property types and again weighted them against each other, and projected loan to values for each different property type, arriving at about a 70% loan to value, given that the property is almost entirely multifamily. That's a kind of standard measure there. In terms of interest rate, we projected it at 4.06%. Which is another parameter that was given in the case. I think it was 250 basis points over the 10-year Treasury, with a 10-year hold and a 30-year amortization.
So you're assuming the 10-year Treasury today is whatever, 1.25, in 3 years it'll be the same?
That's our assumption today, and I think the risk is then built in with our basis over that. We took it at 250. Sure. We actually talked a little bit about pre-leasing. So we do assume that in pre-leasing, the multifamily we think will lease up far faster than the rest of the building. We think we'll be leased to about 96%. That's actually lower than what vacancies are in the market, which is 2.2%. But in terms of retail and office, we're projecting leasing, I think, at 88.
Well, 50% after year one, but for the because the loan to value is measured off the second year NOI, by that point we're about 85 to 88% leased up on retail and office. Yes, what we're hoping is that when you take it to the bank or take it to the debt provider, you can illustrate the pro forma to them, and it can be pro forma debt off the second year NOI. Because in year one we're able to cover debt service, so we think that we're able to show them what the stabilized value is and obtain permanent financing from there going forward. Yes, projected second year. Sorry.
So where does money come from to cover the shortfall in the first year, and what if your projections are off?
So
On the refinance side, if you look at the forward curve and say, you make an assumption that treasuries are higher because it goes into your residual if you paid $48 million for the land and impacts your residual cap rate, how do you justify taking those risks to the investors?
okay. So if I understand correctly, the first part of your question is, could you repeat it actually? Sorry. I'll try to repeat it out to the...
One part was the absorption period.
Okay.
Cover shortfalls.
Okay.
One part was on the residual cap rate, and then treasuries are higher.
Okay. All right, so the first one, in terms of the absorption, the shortfall is, I think, just above, I think it's just under $1 million in year one, NOI to debt service. So, $100,000 NOI to debt service. So we still think, I think approaching the debt source and, again, forecasting a second year NOI with our lease-up assumptions, which we do believe are reasonable with today's market, can, get that debt financing, again, the residual balance about $32 million. And before we did anything with it was finance year one operations on those projected losses. If the lease-up did not go the way we believed it would, the majority of our NOI is actually made up of multifamily, which we think is probably the most, probably the easiest of the three to lease up in the area, especially with how it's growing and how developments are coming in. So in terms of the lease-up with retail and office, it could move slower, but because the majority of the property is given in multifamily, or value of it is created in multifamily, I think the risk is slightly mitigated. In terms of how the 10-year or the Treasury moving forward on the forward curve and how it could affect cap rate, there is, we could take another type of financing out. We could discuss an assumable loan, which I can let Valerie talk about further in terms of financing.
Yeah, sure. So we discussed an assumable loan as well to get institutional investors on board to lock in a lower rate, which I think would be very feasible in today's market. And that is an option going forward, not one that we pro forma out, but we do think that would be accretive to our residual value. There are also other terms of financing that could be considered as well.
They're good thoughts and very cogent, well thought out. In a real world, from the lender's standpoint on the construction, they would give you some term to build. They would give you years to stabilize afterwards, with possible option years in the event that your lower, and the permanent lending market would more likely not work off the pro forma. They want to work off of historicals. So
Okay.
you had to get there and prove it before you make the next jump.
Okay. Okay. Thank you for your time. We appreciate it.
Thank you.